How do bonds differ from stocks?
We fight for your money.
Well, as a bondholder, I have a guaranteed framework of interest payments and repayment. I am a lender. I am not involved in the company's success. That's a very fundamental difference. For us as bond investors, not only does it not matter, sometimes it's even negative if the company does particularly well. I don't benefit from that. And if the company does particularly well, sometimes they no longer issue bonds with the same interest rate, but only with lower interest rates. Or they stop issuing bonds and paying interest altogether. We're actually quite fine with it if the company just moves sideways. As a shareholder, I participate in the company's success. I own a part of the company and benefit from the increase in the stock's value and the dividend payments. Accordingly, it's absolutely crucial that the company performs well. Another point, of course, is that the stock is also influenced by the company's future prospects in terms of its performance. That means if the outlook improves, the stock can rise significantly, whereas the bond reacts much more moderately to this. In this respect, as a bondholder, I have a fixed framework. The main advantage is that as a bondholder, I look to the future and have a fixed, guaranteed framework. I know in advance how much I will receive, but I also won't get any more than that. That is a very fundamental difference.
Thank you very much. Why should investors include bonds in their portfolio?
Helge, because in this particular way, I have a very predictable and stable income framework. The crucial point is, of course, that if I actively participate in the overall success, then I also inherently participate in the significant profit that is generated on the side, which is a very beneficial arrangement, and that is naturally more than the debts they have to service. Accordingly, in the long term, I do better with stocks than with bonds. But the fact is that every stock market, we've looked at every stock market, whether it's the DAX, the Euro Stoxx 6, the yen, the MSCI World, or Standard & Poor's, every stock market has phases where it drops sharply and doesn't immediately recover with a rebound, like it did during the COVID crisis, but instead falls and can take more than 10 years to recover. And the point is this: if I'm now at retirement age or approaching retirement age, and the truth is, when I'm a teenager, I'm broke. When I'm a student, I'm also broke. Then let's say when I'm in my 30s and I start a family, I'm broke again. I buy a house and I'm still broke. Most people only start, let's say, to climb out of the milk jug a little when they're 40 or 50, and that's when they begin to build wealth. By 60, you often have money if things have gone well. But here's the thing: if I have money now and I want to live off it or have an additional income alongside my pension, then it also needs to be somewhat predictable. The problem is, with stocks, I have better long-term performance, but what good is that long-term performance if I have better returns over 30 years? The crucial question is, what will I actually get when I invest? And that's where Murphy's Law comes in. When I invest, or when you invest, it will probably happen that the stock markets crash right at that moment and take a long time to recover. The problem is, even if I sit out those 10 years, instead of being 60, I might be 70. But if I've withdrawn money during that time, I've been realizing losses the whole time. That means I don't even get back to zero after that period. Instead, I'm still at a loss. This leads to a lot of frustration and very little planning security. In the bond sector, I have the big advantage that I receive income. It fluctuates as well, but I have a specific point in time when I get my money back. And that makes investing much more predictable. And here, you don't have to choose one or the other. From our perspective, however, bonds should be an important building block, because this way I have predictability, predictable income that benefits me for retirement planning. But of course, even for someone who is younger, I have this one building block I can fall back on. When the stock markets fall and bonds mature, I can use that money to, for example, reinvest in the stock market at favorable moments.
Very nice. So if you're interested in bonds and want to know more about them, and if you're considering adding bonds to your portfolio for diversification, then give us a call. I would be happy to arrange a meeting with Helge Müller for you, and we can take a look at your portfolio and study how we can add bonds online. This can be especially interesting for older generations. for people who live abroad and receive pensions. That is, those who rely on regular payouts. With bonds, unlike stocks, you already know in advance what you will receive. The key is simply to choose the right issuer, and that's where Helge is, of course, a top guy, because he actually goes into the companies, meets the issuers face to face, visits the company, examines the balance sheets, talks to the key people, and selects issuers where no mistakes are made. That's why I have also invested part of my private assets with Genève Invest, that's the name of Helge Müller's company, and I have to say I am very satisfied with it. Thank you very much. Goodbye on our YouTube channel.